best just to go to my email, or will it jump out at me on the drive?
I can resend it.
That then it would end at 175%. You know the name of it? Do I need to go to the email? If you resend it, is it going to pop up in the drive? Can I search for March?
March, yeah, it's board meeting March 19th.
And you want the PowerPoint?
Yes, please.
Now, 1 second here to share the screen. All right, can you see that, Marvin?
Yes, I do.
I want to do that. I want to click this, right? Yep. Yep. Okay, so you like the mouse?
Perfect.
That would be fantastic. Okay, give me 1 second here. Need the keyboard? Maybe the mouse should be fine, just in case. Okay. Thank you. All right. Get that check.
So, as Chuck said, we did discuss this in December, but one of the things that I want to just communicate with everybody, share with them. Oh, yeah, thank you. I know I can hear better like this, can't you? Share with everyone is we have the fortunate fact of having been able to add Wyatt Trueshite to our team this last fall. And so through this process, he has been able to take a leadership role in bringing us through this bond process for Texas, and his experience with having issued multiple bonds with IDEA has been very helpful as we've gone through. So after just a moment here, I'm going to turn it over to Wyatt to start walking through this bond deal. And he has played again that primary role, and then worked with me from an understanding of ResponsiveEd and how ResponsiveEd works. So just to start, we're going to take a moment to look at what it is, and this is one of these things that, folks, this should be in your board books, the projects that we are looking at for this year. This is very similar to the project list you saw in December. Very little difference. In fact, actually, there was only one project difference between the two. But I want to turn over to Wyatt and say, Wyatt, would you mind just kind of walking us through this bond?
Yeah, absolutely. Thank you, James. And good morning, everyone. I'm pleased to be with you again. And as James said, since you all authorized at our December 11th board meeting, you authorized us to move forward. The management team, particularly the finance team, has been focused on the Series 21 bond offering. And again, as James said, you'll be pleased to know that the project amounts that are listed here are almost identical to what was presented in December. So let's look at these and see how much are we spending and what are we spending it on. So table 3, which is this is what goes into our offering statement. This is actually an official statement that goes into the Appendix A on our bond offering docs. This outlines the projects and the costs by year and by brand. Instead of just aggregating a whole list of projects, we thought it was more clear to segregate it for you all by brand and year. So the big picture, just a big picture comment for a second. We have either built or operating or spent cash, either through our line of credit or our own cash, approximately 102 million of this 149 million of the 2021A bond. So that leaves about 47 million left that we're actually going to disperse from the tax exempt bond. And of that 47 million, about 44 million is strictly 3 projects. It's Prosper, Conroe, and Round Rock, which obviously are the big new TCPA projects. So and you might be saying, well, okay, we've got a 2021A bond and a 2021B bond. What's that all about?
All right, can I get you to pause for a second?
Yes.
Martin and Lance, are y'all hearing okay?
Yes, I can hear just fine. Thank you.
Marvin, you're okay?
Yes, I'm fine.
Okay, thank you, Wyatt.
Okay, great, no problem. So the taxable, there's one is tax exempt, which is the column on the left, and the column on the right is a taxable bond. If you recall, back in December, the board approved what's called a reimbursement resolution, and we have Tom Sage here, so if we have any questions about the technical aspects of that, I'm sure he can address it. So when you pass that reimbursement resolution, the reason we had that is that we were trying to recapture some of the cash that we spent out of pocket. As part of the IRS regulations, you can go back, you have a look back period of 60 days from the date of the resolution, which was the 11th. So we can go back 60 days and recapture anything that we spent our own cash and recapture that through a taxable bond. So that's what we have is two different series here. And the projects themselves, you can see again, the biggest dollars are running through 21-22, which is our Prosper, Austin Classical, and for PHS, an autism school that we're purchasing that's located in Plano. For 22-23, again, the big only project that this bond will finance is the Conroe location. And 23-24, we have already purchased that 3.6 million for Denton is land only. So there's nothing in this bond to finance the actual construction of the school. And then of course Round Rock, which is again a 23-24 opening, approximately $20 million. So in addition to those new projects or expansions, we have money allocated for existing schools, and you can see the list there by TCPA and by PHS. So that's about $50 million in projects. And we have, in addition to that, we have capital improvements, which is basically things like expansion of classrooms and especially like on shirts. I think that's a classroom expansion.
Shirts are new addition. It's at one point you said 4, Robert. What is it now? The Shirts building, is it still the 4 additional classrooms? They're building a wing basically, right?
Yes, it's actually going to be about 8, but it's actually in that. It's going to be between the buildings that are currently there. We're just going to add 8 more classrooms there.
And in a second, we'll show you as a board what you've already approved. You've approved almost everything on this list, shy of, I think the total is like $10 million or something. So we'll talk about that in a second. But to your point, Wyatt, Carrollton is doing a revamp of, it was a church building, doing a revamp of an entire building and it's gonna cost around this, no more than the 5.5. And then Edinburgh Premier CTE used to be a doctor's office, part of it, and we're redesigning the layout of several parts of the building, which is gonna be around $1 million. So back to you.
Yeah, so those are the uses, if you will, of the tax exempt 149 million component of the bond. And then again, we're just reimbursing ourselves on the expenditures we made for Crockett, Prisco, and Mesquite.
So let me just say what I've learned about the Series 2021B, which is the taxable bonds, in the last couple of days. Why we have these taxables? We have these as taxable because we did not have enough money in the line of credit to be able to pay for these projects from the line of credit. If it had been, my understanding, and all the experts on the call correct me if I'm wrong, my understanding is if those had been paid for with financing this line of credit, then they'd be in the tax exempt side.
Yeah, exactly.
All right.
That is correct.
We either didn't have, in this case, we didn't have a reimbursement resolution that covered the 14.5 million, but even then, if we had money in the line of credit, we would have paid for them, these projects out of the line of credit, and they would be tax exempt.
Yeah, I think going forward, Chuck, this probably, other than, like I said the other day, other than maybe some leasehold improvements that occur on some of the lease properties, we should have enough in our credit line to not need a taxable bond going forward.
And the taxable bonds costing us about 0.5% more than tax exempt.
Right.
As of right now, the rates and everything.
Yeah. I mean,
Clarence, you can speak to that once you're introduced, and once we get to that point, you can speak to that. But that's what I'm understanding is about 0.5% is what it costs on the taxable side, more than the tax exempt.
Yeah, that's the estimate before.
Just note, White and I have already spoken with Tom Sage such that every time we will work through the resolution that has been typically used for authorizing the purchase or financing of buildings or projects, and we'll add verbiage in that authorization that is essentially authorizing us to reimburse via tax exempt financing in the future. So we already had that on the docket as something to change so that every time you approve any type of purchase, any type of financing, any type of building, we will just include that automatically.
So let's flip over to the next page in our board notebook. It's the board approvals, what's been approved by the board. This is something I think you would be very interested in is, this is a big number that we're talking about financing, but here are the things, here are the projects you've already approved and the dollar amounts associated with them. So if you look at the totals at the bottom where the $10 million, $10.5 million difference, there's more projects than that you haven't actually approved yet. But if you total up the amount you did approve for some of these projects that we have been under that, then that total, that column previously approved by board, totals up to the 138. So if you were to take the ones where you see a 0, and if you were to total those all up, it would be a little more than the 10 million. But that's the difference. There are some on here that you have approved that show as though you have not. Last board meeting, you approved, well, today we've got, not today, it was the last meeting we approved Westlaco, and that shows us a 0. But just looking down through the list, any of those as board members, do any of those you have questions about them, you don't remember us talking about them, that you want more information on? Plano Autism, that's one of our federal grants, that building. Robert, have we closed on that? Plano Autism?
We have closed on Plano Autism.
And you've not closed on Westlaco yet, but you're about to?
We closed on Westlaco, and we still have to close on the Edinburgh property. 2 years.
And again, understand you have approved those. They're in the board notes. We don't buy buildings without approval, so you just have data that's a little off on the zeros here.
Yeah, essentially now, basically what's happening is you're approving, hopefully approving us to actually go ahead and execute the bond transaction. That's essentially what the resolution is today.
So same thing with Series B. I just brought up each of those has had an approval, prior approval as well.
Any questions on those before they move on with their presentation? Any questions on the projects that you're seeing? Okay. Lance or Marvin? These projects ring a bell. Does any of them you want to speak to, ask questions about?
Chuck, just one question going back to the previous slide. One more previous there. Are we approving bonds here or bond amounts for projects that have not yet been approved? For instance, the capital improvements down there for FCA, PHS, FCA.
You're approving issuing the debt. You're not approving the project yet.
Okay, so but we're approving issuing the debts in advance of approving the projects.
Right.
Okay.
And some
Yes,
point
sir.
in their presentation, they should be talking about the TEPRA notices and the fact that these bond proceeds can be used at any one of our locations. That's my understanding. And
That's
introduce
correct.
Tom, I'll let Tom speak to that, but
Right. That's they're budgeted clearly for these projects, but they can move to any RES campus in the state the way we've gone through this. And secondarily, the proceeds that are not going to pay off the existing loan with Regions will be held at the trustee, and you simply requisition them out.
Very good.
right now, one of you, James or Wyatt, introduce everybody on the call, please.
Let me just run through this. We have on the call Clarence Greer, who
Can you
is
stop sharing for a second so they can see it? Thank you.
There we go. It's Clarence Greer, who is with RBC, our lead or senior underwriter. We have Brian Cologne, who is the lead for Baird, who is a partner underwriter with RBC. Clay Malden also works with RBC and does the analysis, the financial analysis background, and everything that you see and receive from RBC. Then we also have Tom Sage, who is our bond counsel and has been our bond counsel. Just to actually, I'll go back. Clarence and Tom have been with us for each of our bond issuances all the way back to 2015. So they've been with partners with us throughout. And then is there anyone else who's on as part of our bond team? Just kind of running through it. Okay. And then obviously Corey Fisher is there. He just popped on and he mentioned he's been helping out obviously in preparing the data related to our bond. But these folks are here to answer questions. So if you have any questions related to obviously the issuance, related to any of the legal aspects, this is the first time that we have had co-managers on the underwriter side. Previously, it had been RBC had been the sole, but in this case, we decided to go with co-managers. Baird is a strong player in the charter market. They have Wyatt with IDEA has some experience with Baird, and obviously we've enjoyed working with and have had success with RBC. And we thought that it would be good to see them working together and seeing what they can do as a team to provide us the best options here. So they are on the call. Feel free to ask questions of them as we go through, and they'll be happy to answer.
Brian, welcome to the team. You and Baird.
Thanks very much, Chuck. Appreciate it.
Clarence, welcome back. Thank you for helping us do this again.
Always. Thank you.
And Tom, always good to have you involved.
Thank you very much, Mr. Cook.
All right, Wyatt, back to you. Where are we on the presentation?
Let me just, I think Joe had some good questions yesterday that hopefully we satisfactorily answered in terms of some of the processes and how the negotiations work on the bonds and how do we know we're getting fair rates, appropriate rates. So those were really good questions, and hopefully he got good answers. Okay, so as part of our bond process, we put together financial information, obviously to share with the potential bond investors. And so we've got two tables here, 11A and B, which I think were circulated as part of your package. And it shows our prior history, our audited numbers for the past 3 years. Last year is the 1920 column. And then it also shows our current year projections. So where do we think we're going to end up at the end of this year? And then it has some projected years. Obviously next year, 21-22 is our budget year. And then it goes further out. Obviously, forward-looking data is not as accurate, not considered as credible, if you will, by the credit rating agencies. So, you know, we are focusing primarily on the current year projections and then what's happening in 21-22. And a lot of these comparisons are based on prior year. Obviously, prior year is history, so we have 8 months of actual experience in this fiscal year. So we think we have a pretty good feel for where we're going to end up the year. And we're still we haven't really kicked off our budgeting process yet. That's coming right after on the heels of this bond offering. So just a couple of highlights. I'm not going to go through the whole schedule. Just our current year projections are showing about almost an 18% increase over prior year in terms of enrollment. 22,067 versus 18,739. And that's in terms of our average daily attendance, we're showing about almost a 16.5% increase over prior year. And then our state funding, we're projecting at about 10,132 per student, which is about a 1.26 increase over prior year. So what's our total revenue look like current year? About 230 million, about 18.75% increase over the prior year. So these are really strong numbers. We've got a good trend going, and the enrollment growth obviously drives a lot, is the main driver behind a lot of these metrics that we present to the bond market. On 11B, so 11B is just a summary of revenue and expenses to get down to our cash flow for operating, our cash flow available for debt service. That's a key number that our credit rating agencies focus on. So that's why we present it this way. We do get down to the typical P&L where we show increase in net assets eventually, but this is really the key number, and Clarence and Brian know that this is part of a big part of the methodology that Standard & Poor's uses to evaluate. And we did have our meeting last week, by the way, with Standard & Poor's, and it went very well. So for this year, we're showing our current year projection of about 34 million in cash flow available for debt service. I use the word EBITDA. Most of you are familiar with that. And so that's a healthy increase over last year, which was 25 million. And our percent, it's about a 15% EBITDA rate, which is a good rate. I mean, at IDEA we were running somewhere around 18%, but this is a really strong operating income. You can see in blue, you can see what our coverage ratio is. It's the 4.30. So that means we've got $4.30 in earnings for every dollar of debt. So that's a really strong number. And
give context on it. The covenant is 1.1.
yes, 1.1.
And what 1.5? Why is 1.5 in my head? What's that number mean?
1.5 is if you had a 1.5 coverage, you'd have $1.50 for every dollar of debt. So
yeah, James, there's a reason that
Yeah.
that you have that 1.5 on my mind. 1.1
Yeah,
is like
1.5.
you can't go below it or you're violating your covenant.
Well, yeah,
The
1.1, you're violating your covenant. 1.5 is that we wouldn't want to go below. If we go below that, we're not gonna. They're not gonna look at us as a triple B flat.
You lose your rate.
Our rating would be in
yeah,
serious.
if you look down just the next section where we talk about the MADS, which is maximum annual debt service, you can see the 1.58, and that's what Chuck is referring to. Our coverage is 1.58. And what they do is they take the current debt, or the existing debt, plus the new debt that we're going to issue, and they compare it to our EBITDA from last year, the 1920 number, the 25 million. That's how that's calculated. So it's a very conservative methodology because they layer on new debt without all the benefit of additional students and additional revenue. So and that's a good strong coverage ratio. We think it's good enough for a triple B plus rating, but that's obviously up to Standard & Poor's. So the section above that gives you the annual coverage ratios.
We're talking about we're looking at this debt coverage, this annual debt coverage, 4.3, 3.39, 3.5, and 22, 23, and the number really has to be the 1.5 if you're triple B flat, and it would be higher than that if you're triple B plus. Did I say that right, Wyatt?
Yeah. Between 150 or 1.5 and 1.6, and so we're. If you look at there's a table behind this called 11C. You don't have to go there yet, but that's just the new debt. And if you look at that coverage ratio, it's 1.62. But that doesn't include some of the other minor debt that we have. So our real calculation is 158, but it's 162 on the new issuance. So I really want to.
I'm not following you.
Well, we do a I guess a pro forma, for lack of a better term. What's our coverage ratio based on existing bond debt?
Where's he at?
11C. I don't know if that's in there or not.
So
Where's 11C?
Wyatt, we don't have 11C in here.
Okay. Well, anyway, what it
Right here.
basically does, it takes existing bond debt plus new debt
That's what he
and
said.
it compares it to our 1920 EBITDA and calculates using the same calculation.
He is looking at the 1.8 that's it says MADS, MADS coverage based on 1920 EBITDA.
Yes, that's what that 1.58.
We have the only reason it's different. The only reason it's different is we have a little more. We have some bank loans that are we're putting into this.
That's the number after you're paying the interest and
Yes.
principal.
So it's based on our fiscal year 1920.
But it's
But
when
it's
in
based
22,
on
23 is when you're paying
when we're paying
you're paying
principal and
interest.
interest, right?
Okay. So that guys would be, gentlemen, that would be the high watermark of the debt when we issue
Yes.
it. Right. But it's using, as they're saying, they're using the 1920, which is last year, right? Already closed out. Are
Right.
you,
Yeah, it's layering on new debt on on prior year earnings. So it's very conservative.
Yeah.
But I would say responsive. If you look at the debt service per ADA and the percentage, those are very low. I mean, those are really good numbers. Obviously, we haven't issued debt for 5 years, so they should be good. Okay, change in net assets, which is basically our net income. We're projecting about 21.5 million this year. And our cash position at the end of June 30, it's really a snapshot. We take a snapshot at the end of June, end of our fiscal year, try to calculate what our days cash on hand. 150 is kind of the target that RES has stipulated. And if you look at the 1920, where did we end up in 1920? Well, if you include interest, we're at 156 days. Without interest, we're at 162. So those are really good numbers as well. And so we always we have in the past and going forward, think 150 is a reasonable number. And it's also considered by S&P to be a kind of a benchmark for a BBB+ rating. So we'd like to be above that. We think we will be. Our current year projection, I think, is low because we're going to get cash back from this bond offering, cash that we've already spent. So we think that number is going to be significantly higher than 150. Just talking a little bit, we're still working on the projections. It's a work in progress. We think it's probably, we need to be a little more conservative. So we're probably going to take somewhere around a 25% adjustment overall to the bottom line, just to be make sure we're not only meeting but exceeding expectations. So we're still working on that. We're gonna make some adjustments, and we should have those finished next week. Any questions?
all right, what questions do you have so far? We appreciate Joe's questions that he had already submitted. We can go through those if that might be a benefit. Let's see if anybody has other questions, but Wyatt, if you'd find those, we may go through those if we don't have a lot of other questions.
Yeah, sure.
So Wyatt, you mentioned that we're working on the projections to make them a little bit more conservative, which is probably prudent. What do you think the biggest risk is to the projections going forward? Is there anything that any concerns on the projections?
Yeah, I think we probably will take another look at our enrollment. I mean, that's such a big driver of everything. I mean, there's not a lot of, I don't think our expenses are particularly out of line in any extent. So we'll probably look at enrollment because, again, that's such a big driver of everything.
What about new schools? To what degree does that influence the projections? Is there any risk associated with, timing delays or something like that?
Well, I mean, I would say, given the fact that most of these projects have already either been completed or certainly underway, and we've purchased land, I would say there's not much risk in not moving forward with the projects that are listed here, and that's through 23-24. So I wouldn't think that that's a particular risk, given the amount of money that we've already spent. 102 million out of the 148, so or 149.
Joe, most of those projects are generating revenue at this point. They're or will be pretty soon, except for Round Rock. Would be one that'd be a little bit further out there, but the rest of them are going to be generating revenue.
Conroe, right? Round Rock. Right.
Well, Conroe would come on in 22. Yeah. Conroe in 22, Round Rock in 23.
And Prosper this year.
Prosper will be generating revenue this fall on phase 1.
All right.
Other questions? Did you find that list of questions, Wyatt? Why don't you go through those?
I did. These are questions that Joe sent yesterday. He was asking about the audit engagement, how many years we've been with Kirk Evans. And as Chuck mentioned, it's been 10 years. And also, you know, he wanted us to describe the negotiation process that ensures a competitive rate and fees, which is a great question.
And why we have the deck and a page that speaks directly to that.
I'm sorry, Clarence?
Clarence, you can cover that when we get to that point, then that's fine.
Right. We have a page that speaks directly to that question.
Okay, great. And Wyatt, what are the other two questions?
The other question had to do with, you know, where on the projections, you know, where's the new debt? Where's that added? You know, why interest payments are going up and why principal payments are going up. And there are specific line items on the projections that have annual interest costs and annual principal payments. And so we're adding the interest payments from this bond offering in 21-22, and it's interest only until 22-23. So the principal goes up in 22-23. But we have specific lines that identify interest expense and principal payment. And we're adding those in the appropriate years in which the additional interest and debt is incurred.
So it's interest only until
22-23.
I'm sorry?
22-23.
That's 2 years, 24 months?
Yes.
Okay.
And then it asked a question about the unrestricted days cash on hand without interest. And we did resend a document to Joe that shows we had 150 in the out years with interest and without. So obviously that was just a placeholder because our target is 150 days. So we just put 150 days in there. We actually put the calculations in and resent it to Joe.
All right. Okay. Thank you, Wyatt. So before we move into hearing from RBC and Baird, do you have any questions about what projects are being covered by issuing this bond debt? Okay. So the next section, I think, is really primarily around where does RBC, where does Baird think we're at as we issue these bonds, what kind of rates we're going to get or have to pay on the debt. Is that right?
That's exactly right.
Where's the market?
And they sent a new one, which did not get into the, so I am bringing up this one. Oops, that's not what I do.
Yeah, but
I followed your example. How about that? You are the leader. All right, Clarence, just tell me when to move.
Okay,
let's go to
the next page, James.
Here.
And we have Brian on the phone as well. So you know, thank him for working in conjunction. On page 2, we have a summary of the whole team, and to the left, and we have Tom Sage, your bond counsel and tax counsel, McCall Parkers, our Underwriters Council, ourselves and Barrett as your underwriters, and Standard & Poor's as the rating agencies. To the right, you can see the preliminary timeline. Standard & Poor's, we met with them on the 17th. And I gotta say, your staff did an impeccable job making the point of, how RES has separated itself, in terms of best practices during a pandemic, having pre-positioned itself to already be established in virtual has definitely accelerated. And then all the branding, you've been able to maintain your enrollment where, there's, notable declines in enrollment across the state. So the amount of conservatism that Wyatt displayed was, S&P really was complimentary of, James and Wyatt as relates to, not factoring in, a lot of federal support that, many of their peers might have been a little bit more bullish. So you're extremely conservative. That's being considered. And, Brian and I, we made a strong argument, closing argument for an upgrade to the BBB plus underlying category. Obviously, these bonds have been guaranteed by the Permanent School Fund and their AAA, but the underlying rating does matter as well. We'd like to get that as high as possible. So we'll hear back from Standard & Poor's on the 25th. And I think irrespective of their decision, I got why I think you'll collectively agree, James, that we have a lot of positive momentum, with our conversations with Standard & Poor's.
Great.
Then we come upon Good Friday on the 2nd. So we're targeting a pricing date.
Sorry to interrupt you. We on
Yes, sir.
SP, would there be any benefit to have more than one rating agency? Please educate me in terms of a transaction such as this. Is that necessary, or how does that typically work?
Right. It has. As it's something that we will definitely want to explore in the future. And, Moody's, for so long, Standard & Poor's, they were the long range, if you will. Over the last 18 months, Moody's have become more of a player as well. And, particularly in the entrance of the BBB minus, they've been a little bit more liberal, granting access to that classification, which is very, very important. Investors are still looking more toward the Standard & Poor's. I think over time, they're going to start accepting the Moody's rating on par, but I think they're somewhat, looking more toward the S&P rating just because, they have more history with Standard & Poor's, as Moody's kind of got out of the business for several years and now making a major, re-entrance into the business over the last, say, 18 to 24 months. So I think it was something we explore in the future.
Thank you.
On page 3, we have your debt portfolio in terms of bonded debt that's outstanding with the master trust that Tom Sage and his team has set up. These are the parity bonds that are already outstanding. We have 3 series. We have a Series A and a Series B in 2015. And you can see the true interest costs associated with them to the far right. So when you look at our debt portfolio, we have issued about $127 million in the past with an average true interest cost of about 3.45% or 3.52 all-in true interest costs. So, that's how our debt looks in the bottom, very level debt service, and it kind of drops off, in the final 2 years. So that's our debt paint. On page 4, this is where we want to kind of compare where we are interest rate rise today versus where we were when we sold the 2015 and the 2016 bonds. So when you look at the left-hand side of that PowerPoint screen where it says today's MMD curve in context, that MMD is an index. It's called the Municipal Market Index. That's the tax-exempt index that we price your bonds or all bonds against. And that general index you can see is, as of the close of business yesterday, is the light blue solid line. And you can see MMD is currently below where we were when we priced the 2015 A and B bonds and the 2016 bonds. And then you can see the 15-year average. So we're well below that. That's where the majority of your bonds are going to be sold on a tax-exempt basis. So that's, I think, from a relative standpoint, we're in a lower general market than when we were the last 3 times we sold bonds. On the right, we kind of compare the U.S. Treasury to 10-year rate. You can see yields have increased both in the tax-exempt market as well as the taxable. And to the chart of the right, you see that's U.S. Treasury 10-year. That U.S. Treasury 10-year rate has kind of separated itself from the tax-exempt rate. So we're not seeing as much of a move in the tax-exempt world as what we're witnessing in the taxable 10-year in the taxable space. Obviously there are global concerns of inflation there. But in both cases, we are in a rising interest rate environment over the last 6 weeks. This phenomenon of increasing rates have just kind of happened and evolved, and it's really moved up fairly significantly. However, it's still below where we have sold bonds previously. The next slide, to kind of put that in further.
I know your crystal ball, my crystal ball doesn't work terribly well. You made the point relative to history, we're in a good rate environment and it's currently rising. Do we have any anticipation of what's going to happen in the next month, 2 months in the near term? Do we anticipate it's going to continue to rise?
Let's look at what the Fed is doing. We had special provisions for the global pandemic. They relaxed the capital requirements of banks, so banks could hold less capital. There's now they're saying they're not going to extend that, and so the old capital requirements are coming back. Hopefully, they'll reconsider it. There's a renewed fear as a result of that decision by the Fed that banks might start selling treasuries as well into the market, causing additional pressure for yields to go higher. But I think there's a lot of general thought that we're going to enter into a trading range on the U.S. Treasury from 170 to 2%, and it'll kind of be within a range until something materially different happens. That's the general consensus, that we're seeing. But there's a huge short interest in U.S. Treasuries, where the bet is that rates are going to continue to move higher than that. And so it's going to be interesting to see, if the Fed's going to reinstitute a more aggressive, buying back of Treasuries using its balance sheet. I guess they call it quantitative easing. That could definitely, start moving, yields lower. I think they're kind of, taking a more measured approach in this, but, it definitely has people concerned, that inflation is here. We need to manage it, but no one really, be interested to hear what Barrett has to say about your economists. I don't know if they strongly disagree with what I just said, Brian. It'd be interesting to hear from what you guys think as well.
No, thanks, Clarence. Can you guys hear me okay?
Yes.
Yeah, I think we're on the same page. The only thing I might add is that sort of decoupling between treasuries and tax exempts is just purely a function of, potential, you probably have read potential increases in tax rates. So there's still a lot of money in the tax exempt mutual funds and money managers that is helping our market out a little more than the treasury market. Now, ultimately, we do follow treasuries. We can't get away from that. But like Clarence said, we're coming off historical lows. So, we lost some ground yesterday, but as to Clarence's point, I think we'll probably remain within the trading range until the first week of April when we price the bonds. So we're still in a pretty bullish environment overall.
You know, and to support what Brian is saying on page 5, when you look at the index, money coming into the bond funds on the lower chart, this is the money inflows and outflows of the bond funds, that are you know, the Black Rocks, and we'll get into who some of your investors are. You can see the first week, you know, after the election, you know, in anticipation of higher rates, our, you know, tax rates, municipal bond funds experience significant millions of dollars of inflows. And it's just these last week or so, you start seeing just some small outflows. But we know there wasn't a lot of supply, not a lot of transactions in January and February. So that money still has to get put to work. So, you know, I think your timing, you know, from a practical standpoint is really strong. We'll have the benefit of having those dollars come into our transactions, unless the portfolio manager is just making a call that higher yields are just imminent and they don't want to put all the money to work. And so, but I think we're going to be fine. I don't think that's going to be the case. On the bigger perspective, since 1961, you can kind of see where we have been. And, you know, so while we're talking about a rising interest rate environment, we don't want to lose the big picture. We're still at historic lows, still a great time to borrow the money. You know, back in, you know, obviously we see the peak, you know, with the oil crisis when President Carter was there, you know, it led up to that, but we're nowhere near those type of levels, just a totally different interest rate environment.
So all in cost, in 15 for A and B, you see that here, and then you see 16, and you've averaged them. It was our current debt's 3.5%.
Correct. Your debt portfolio is about a 3.5%, and we believe that on page 6, we'll be able to achieve the tax-exempt rate of about, depending on the structure, a range, call it between 2.4 to 2.7, 2.8 if rates continue to move higher. You know, this is a snapshot. So what we really want to focus in on is that spread over the municipal market data. On any given day, this is moving higher. And in fact, since we ran the numbers last, it was March the 19th. In those 9 days, we're about, you know, about 10 basis points higher. You know, 9/100 to, you know, 9/100 to 1% or 10 basis points higher, 9 or 10 basis points higher than where we were, you know, just 9 days ago. So, you know, we are seeing movement, but you know, I think generally speaking, we're still well below the 3.5. And then also, this is where Tom Sage comes in. The parameter that the board is going to be adopting this afternoon is going to be, I think 4%, right, Tom? You know, that we have set there.
Correct. That's correct.
We have 4% on the tax exempts, which is, you know, we're well south of that. And then also even on the taxables, 4% as well. And so with the taxables,
Time when we issued it, I mean, it was just amazing. And right now we're possibly down around 2.5. So we're in a good place.
Yeah, right. And the same is true, Chuck, on the taxables full disclosure. When we looked at this on the 10th, 9 days ago, it was a 152. If you look at a 10-year U.S. Treasury now, it's more of a 172 instead of a 152. So just like that, 9 days, 20 basis points. You know, I think there's typically going to be some type of, you know, hopefully a trading range that Brian and I both agree on that we're looking to hopefully capture. But we'll be definitely focused on that.
If we had issued when other people were telling us to issue a year ago, we would have been not as good, right? So even though it's going up, we are still in a better place than we would have been for sure 2 years ago.
For sure 2 years ago. Last summer, we probably would have been better last summer. But
so anyway, we're in a great place.
We're still in a great place.
You're still in a great place.
Time at that.
That's exactly right.
Right.
And the good thing, Wyatt and Chuck, you're ready to go right now. We know that there's an avalanche of supply about to hit the market.
Right.
I mean, Dallas is coming with $500 million, Dallas ISD. Yeah, I think, Clay, when is that? That's coming within probably shortly after our transaction, right? 200 million. So within a very
And
short
we
period
know
of time,
where all our kids are.
billions
We
will
had
be
lost
hitting.
15% of them, so.
Right.
That's a good thing.
Very good thing.
The ISD can't find 15% of their kids.
They can't. Yeah. So, we have a lot of information here. I would like to skip, we have like different comparables of transactions. And I think it really kind of speaks to that, we're both looking at the market, and it kind of speaks to the point of how do we know we're getting a good transaction? We're definitely in the market, both of us, and we want to be able to line your transaction up against, maturity by maturity against other school districts and charters that have recently priced, and see if we can be in the ballpark or be, have a comparable spread versus where that transaction is. So we want to be competitive, knowing that the market tone has completely changed. Nevertheless, we still want to be competitive, have a market rate. And so that's one of the things we just have here is a indication of transactions. I don't want to spend a lot of time there unless there's some questions specifically about KIPP Texas, or, we got Uplift that Barry had led, Yes Prep and others. But I wanted to kind of get to where Wyatt was. I think you were looking for on page 11. I think you were looking for this slide here, Wyatt.
Yeah.
Right. So in terms of the coverage, and so this is kind of looking at all the parity debt. It excludes some of the smaller loans that you throw in. It'll be a 1.58 times coverage. But when you just look at all the parity bonds, it's a 162 coverage on the senior basis, which is extremely strong coverage there. But then on page 12, let's kind of get into who's going to buy your bonds and how this process works. So we're going to print an offering statement that tells your story. It's been 5 years. So that statement might be accompanied by a live audio or given a Q&A, so that could be a possibility.
We don't have a page 12.
I'm sorry?
We don't have a page 12, by the way.
Clarence, we have the old presentation here that was printed out for folks, and so they can.
Okay, that's fine.
Really
so that's it right there. So potentially, probably that slide there that's up on the screen. So what we've done is kind of taken the major investors from each of your peers have sold PSL bonds and look at their portfolio and say, well, who are some of their top investors? And so you start seeing some common names across the top. Lowe's Corporation, you're seeing some others, Pine Bridge and Vanguard. And so these are the institutions that are going to be actively looking at and looking for your bonds as part of their investment portfolio. And so we're going to be, obviously we'll be marketing to them and working with them and answering any questions once that preliminary official statement is in their hands. So the question, Wyatt, that you have, how do you know if you're getting a good transaction? How do you know what's the competitive process? How does that look? So we tried to build a hypothetical, Wyatt, on this next page that kind of addresses that. And it really comes down to two things. It comes down to the bonds that are offered on column 2. And this is maturity by maturity. So let's look at the maturity in 2008, 15, 22. There's, say $2 million. This is all hypothetical. 2,095,000 bonds offered. And so that wire will go out to all that universe of potential investors. They'll see it and they'll say, do I want to participate? Do I want to submit an order? And do I like those levels? They'll say, okay, the yield. So look at column 4. That yield is in column 4. That's the yield that we would preliminarily have price discussions with. So say that's 20 basis points, just for Yeah, and then, so based on that, we may get, say, a lot of people say, you know what, we don't want it, we don't like it, it's too low in terms of the interest rates are too low, we want more yield. So say if we only get 3 orders for that maturity, but they're all or none orders, so we're 3 times oversubscribed. We have 3 times many orders submitted by 3 different investors that we have bonds offered. So what we would do, conventionally wisdom, is we would say, is there a way, let's try to squeeze those investors. Let's go down by, say, 2 or 3 basis points and see what happens. So 1 or 2 things will happen. Either they will accept the rate, the lower rate, and hang on, and then we would have to kind of give each one of them, you know, a reduced portion of their initial order, because they're not going to get all of it. Or they, you know, 1 or 2, or maybe all of them say, I don't want it at that level. And they always can back away. And at which point, you know, RBC and Baird would be responsible for buying those bonds. We would underwrite those bonds, and that's what we've done in the past. And so you can see, we will repeat that process. And this all happens on real time, on the screen. You can see it on your computer. It's very fascinating, where it all boils down to supply and demand. How many orders we have relative to how many bonds are offered at each maturity.
Yeah, we can get you all log in. You ought to watch it. It's kind of funny if you've never seen it. Pretty amazing.
And then it gets down to this other part, you know, where sometimes you might not have any orders. And then, so then there's a discussion, so what happens there? There might be a restructuring, maybe, you know, we need to move some investors to another maturity, or maybe RBC and Baird takes those bonds at market into our inventory. And when we do that as a demonstration of our loyalty and commitment to you, because that's printing losses. That's, you know, there's no way around it. We'll hedge it at a loss. Or we can buy it and do what I do with my personal portfolio. I hope and pray that my losses turn into gains, but unfortunately they turn into bigger losses. And so I don't think RBC will do that. They'll just pretty much cut their losses and keep moving. But we will take you out of the risk business on the day of pricing and make sure maturity by maturity, we get you the absolute market rate. And that's how we know that you're getting a market rate. And sometimes that costs us, you know, part of our underwriting fee, because you just don't know what the investor's going to do when you make those adjustments. And so, and going into it, we pay our sales credit based upon what other transactions have priced. And we're a big believer in parity. What we're trying to do is get your pricing to be equal to that of a school district, even though you don't have the tax base. You have the same guarantee. So right. we want to, in the spirit of that, we would like to be able to propose, you know, a sales credit that's commensurate with what we would see factored in, you know, not just your, you know, your charter school peers, but also your peers in the traditional ISD market, which tends to be a bit lower. So that's what we'll do. Share that with your executive team. Show, hey, here's where the sales credits have been, and we want to definitely be, you know, right within that median there. But it's a great process. You can watch it real time. Well, it's an open book. You know, like Baird and I will share with you and your team. We can give you a nice login. You can see real time how these decisions are being made, and I think and all while the market itself is moving. So you got a lot of things moving, but we're trying to, and it takes about an order period. This is about a couple hours. We probably would go out at about 9:00 a.m., run an order period to 10:30 Central, and then take 30 minutes to kind of tabulate where this is, get this order book together to present to Wyatt and James and Chuck and whomever else there on the phone call, and then kind of go through it maturity by maturity. Hey, this is what it is, and then what we would do, basically submit what we call a bid to underwrite. And then you guys will look at it and talk it over and think about it, but you would see a clear, rational line of thought that's backed up with reason and data. So it'll be very understandable like it has, and very transparent like it has been in the past.
All right.
And James, I know you've been in these, and why you've been in these several times. You might be able to speak to it as well. Very transparent as you look through it.
Okay, thanks, Clarence.
And then on the last page, what we'll do is give you a post-mortem like we did. And we'll come back to the board, give you a sheet that with your information that says exactly what happened. And so you'll have that as well. And so, this is just an example. We'll put your numbers in, but we'll put that as a post-mortem of the transaction. Give us, a couple of weeks after pricing to get everything in order, and we can get this out to the board just for transparency purposes as well.
Okay.
Okay, that's all we have.
Appreciate that. So what is the, Tom, what's the request today?
The request today and the resolution that we prepared for the board authorizes you and Wyatt and James to pursue the transaction that Clarence just went through within the boundaries that he outlined. It's an amount not to exceed, I believe, $166 million for the projects that we've talked through in the rate environment that you guys just saw a presentation on. Obviously, your underwriters will attempt to get the best rate possible, but this would allow us to go forward with this transaction in early April and hopefully close it on April 29th after taking it through the Attorney General's review and approval process.
You have questions?
No.
We discussed this in December. We started down this road. Are you still comfortable? Any
Appreciate the very thorough presentation. Thank you.
Yep.
You're welcome.
Don't have any questions? Then we need a motion to approve. What's the motion? It's approving the issuing of debt, this bond. How would you say that, James?
It's just to approve the resolution.
To approve the resolution. So
Yes.
You heard Tom talk about what the resolution is. It's say the dollar amount again,
166 million.
166 million,
With
and
a
no
rate,
more than 4%.
rate not to exceed 4%. That's exactly.
So moved.
Okay, Lance makes the motion. Do we have a second?
Second.
Marvin makes a second. Any questions or thoughts? Discussion?
Makes sense.
All right, all in favor, say aye.
Aye.
Anyone opposed? Okay. Motion passes. It's great. Thank you, guys.
Thank you very much.
Thank you for being on the line, everybody.
Thank you, everyone. Very much appreciated. Thanks for the presentation.
If I can keep the board on for a second. The board, we would like you to vote. We did not record the consent items, so can we vote on video for the consent items? Consent items 1 through 5. Whoever remembers, who gave the
So
motion?
moved.
Okay. Joe, and who second?
Second.
Kent, all in favor?
Aye.
Aye.
Anyone opposed? All right, consent items pass. That's it, guys. We have lunch here if you want to stay around. Sorry, Lance and Marvin. We'll send you an Uber Eats.
I have a question about this mask situation.
Okay.
Should we be discussing that, or?
Chris, how do we handle that? We can just have a discussion on it, or?
Actually, right now, nothing's on the agenda regarding that. So that's the recommendation. So if there's notice to the public, is that if we want to have something for discussion item, we place it on the agenda and we discuss it. That'd probably be the proper.
It'd be best not to have a discussion on it since it's not an agenda item. I don't know if you heard that.
Yeah, I apologize. So the public comments we don't know what is going to be discussed at that point. So we don't know what they're going to comment on or not. So the public comes in, they say whatever they want to say. Then the board, based on the comments that are given, can say, you know what, this piques my interest on a future board meeting. I would like to discuss this topic. And so you could set up another meeting in a week if you wanted to. You can, whatever you want to do to get proper notice, I guess within 72 hours. And then we place it on the agenda, the public has notice of it. And then because it's on the agenda, you could actually have people come in and speak to that agenda item and then have free discussion in a public forum.
You can go into closed session for one item is to consult with the attorney about anything.
Anything. Generally speaking, though, even the consultation with the attorney deals with something that's been on the agenda for which there's been given notice.
Okay. So that's our legal counsel's advice on whether we should talk about it in open meeting or in any kind of forum at this point. What does the board want to do with that? You want to talk about it? You go in closed session and talk more about it with the attorney?
Just a question, is that a board decision to change that, or is that an administrative decision? How would we make that, is that even a board decision?
Yeah. The board could set you, the process could be, you could say, hey, in 3 days, we need to post this, we want to discuss it, and you can discuss what you want to change or keep in place regarding the parameters for the mask. Yeah, absolutely.
As far as the removal of the mask that's in our health and safety guidelines, that would be the board's decision, yes. And with the governor removing the statewide mask mandate, he then left it to the discretion of TEA. TEA, a couple of days later, their guidance was to keep them in place, but the local boards can decide if they want to remove that mask requirement. So it's the local board's decision.
Okay.
All right, anything else? So if you want an item added, let me know, or Ben as board chair, let Sarah know. And we can either have a meeting before the next regular scheduled meeting, or we can add it to the agenda at that time. Anything else for today? All right, thank you guys. Appreciate it. Have a good lunch.
Thank you.
Thank you.
Yes, make sure we're now adjourned, and make sure we do this right, James. I think you hit